Hi, my name is Tammy, and today I am going to use this opportunity to give an introduction about a stablecoin risk assessment framework that we are currently working on. Is the sound? It's perfect. Okay. So in the next 20 to 25 minutes, we're going to talk about the goals and motivation, how the framework works, and then we're going to deep dive into the method we use to measure stablecoin risk to regulatory risk to stablecoin users. And before deep dive into the topic, we would like to talk a little bit about ourselves first. So, and this project is for public good. It's completely independent from our full-time job. I received a grant from Eastern Foundation ESP to kick off the research. And later I team up with Aleksandra on the regulatory risk assessment. Aleksandra is a legal professional from a major protocol foundation. She led stablecoin regulatory research for risk and protection dashboard at Cambridge Center for Alternative Finance. And about myself, I am working in the protocol specialist team, specialized in blockchain analytics at a crypto exchange. And I was a credit risk modeler in banking for a couple of years before that. So I think everyone must be really familiar with the two most significant stablecoin events in the last 2 years. The one on the left-hand side, it is the fall of Terra. UST's value was down from $1 to 10 cents in just a couple of days in May 2022. And then on the right-hand side is the Silicon Valley Bank collapse. So it started from some USDC holders got worried about the USDC reserve got stuck in SVB. And then later, other stablecoin, especially the one who has exposure directly or indirectly to USDC, also lost their peg. So later, this stablecoin price recover in 3 days after FDIC announced that they're going to enable withdrawal for all deposits. So why do I mention these two events? There are many very amazing in-depth stablecoin risk research available around, but for common user, the metric they use the most are circulating supply, one, and market cap. And on doing analytics, sometimes you can see price volatility, liquidity, unique number of addresses. But if you look at the Terra's case, the reason before its collapse, it was the third largest stablecoin in the world with a market cap of $18 billion in April, just before May. And then its collapse is because it has a fundamental flaw in its design. It is under-collateralized by default, and then it used Luna to back the stablecoin, which has a circular value, and it can be down to zero. And for the USDC case, it's one-to-one reserve back. But the reason that it went temporarily pegged is because it is exposed to the custodian risk, where cash exists as banking note. So therefore, if we combine all the metrics that I just mentioned, they are just not good enough for stablecoin user to assess and understand stablecoin risk. So that's why we have SRAF, Stablecoin Risk Assessment Framework. Our goal is to build a risk assessment framework to analyze stablecoin risk from different angles. It should be easy for user to understand, and all information should be able to derive from public available information. And then the main motivation of this framework is to encourage more risk-driven decision rather than trend-driven or return-driven. Many existing analysis focus on the DPEG event, but within there are also other events that could potentially cause a negative impact on stablecoin user, which is not only the user who holds stablecoin, but also the user who borrow or lend stablecoin, for example, or provide liquidity, provide liquidity to the pool. So this is the event we summarize. One is when price become too volatile over time, can be either too high or too low. In this case, for example, loss may incur when stablecoin user has to buy at a higher price to repay their lending position. And then secondly is price significant lower than the peg value. In this case, the stablecoin may or may not be able to recover to its peg position. For the later case, then the user will take a haircut into at their stablecoin holding. And then the third one is a complete failure of the project. That's what happened to Terra. And then the last one is the stablecoin value is still there, but the user is not able to access the stablecoin. And it is often associated with user being censored by centralized party or authorities. So the framework is further break down the risk assessment into 8 categories: asset backing, stability mechanism, issuance and redemption, liquidity, governance, smart contract, oracle, and regulatory risk. Definitely, the asset backing, stability mechanism, issuance, and redemption are the 3 key pillars for stablecoin risk assessment. But I'm sure there are many talks here talk about this issue. So today we are going to focus on regulatory risk. And here it is why we are going to dig into some of the example or the event happened in the past to showcase why regulatory risk to stablecoin users is important. Before that, the challenge of having single rating, our framework is not going to produce a single rating because we believe it is not time yet. It can be misleading if the user is unaware about how the single rating is produced and what it is represent. The challenge is that, for example, it's difficult to assign weights on different risk categories because it is based on the person who create the ratings on objective. And then for now, the industry is still quite young compared to TradFi. So there's not enough data for a good probability of the PEG model. And also, not only the PEG matters, as I mentioned, there are also other events that's very important. So our approach is use the framework to allow user to use the framework to analyze and compare risk among stablecoin and user themselves to decide the importance of each category based on their own objective and risk appetite. The first event I'm going to go through is the BUSD unwind. In February 2023, New York DFS ended minting of BUSD at Paxos. And then later in the same year, Binance stopped supporting BUSD. Then you can see on the right-hand side, the supply of BUSD dropped sharply since February last year. What happened to the users? Users were able to redeem BUSD at 1-to-1 as the reserve was not impacted. Something worth to mention is that Paxos is bankruptcy remote, but users were not able to trade BUSD on Binance anymore. And then the second one, it is FTX collapse. In December 2023, IRS demanded $24 billion from FTX for unpaid tax after their collapse. The impact to users, some remaining assets was used to pay bankruptcy lawyer And they managed to negotiate down to a lower value, but of which 200 million was paid before client compensation. In this scenario, it is not exactly stablecoin, but what happened if FTX has its own stablecoin and then its reserve? Is it possible for reserve be impacted in the same way? Then it's the Binance enforcement. In November 2023, Binance was fined for 4.3 billion for various wrongdoing. CEO seized this step down and was sentenced to jail. No direct impact to the user as Binance has the money to pay. Several countries, including Australia and Cyprus, revoked or suspended Binance operating license. But what happened if Binance didn't have the money to pay? Then the last one is we saw a rise of yield-bearing stablecoin. Then you can see from August 2023, there's a sharp rise in circulating supply. Not much happening yet, but they are definitely the category that easier to be identified as security. For example, Paxos Live Dollar USDL is not available in the US market at the moment. So in summary, regulatory action is closer than you thought. It will directly or indirectly impact stablecoin users. If you assuming all other aspects or stablecoin functions as expected, the primary risk of regulation actions to stablecoin users still remains. That is, will their stablecoin holding be impacted, or will their stablecoin trading activity be impacted? Then
Yeah, thank you, Tammy. Just picking up on this point, just like users and customers, you're asking this sorts of questions. Will my stablecoin holdings, will my position be impacted? Will the regulatory or enforcement actions in any way impact my trading activity? The regulators, they have to ask themselves a question: is my regulation structured in such a way that the stablecoins provide customer protection, sufficient levels of disclosure, enough information about the project, whether the redemption mechanism is structured in a correct way, is the right to withdrawal preserved, both in the primary and secondary market. Yeah, and I think for like a regulator, a massive concern is that some of these projects, they operate on such a scale that they, in a way, resemble operations such of the banks, central banks, and money issuance is predominantly an area of central banks. So the regulators cannot just turn a blind eye into this, especially in the EU. There are sort of this super issuers which trading volume, daily trading volumes is over 2 million transactions. They have to come up with a plan or how to minimize their activity so that it does not resemble or compete with the role of the banks. Yeah, and then going a step further, from a financial stability perspective, they worry that such projects' failure will have the domino effect and could impact regional and supranational financial stability. Right, so moving to the key stablecoin regulatory frameworks, let's just have a brief look at the current regulatory responses to stablecoin activities, starting with the US. I think one major regulation that we should mention on top is FIT21 Act, which is worth of noting as it's passed with an overwhelming bipartisan support. It's a market structure bill, and it kind of fills in the regulatory gaps that people have been asking to be filled. So it defines permitted payment stablecoins, and it also specifies how the stablecoins can be traded through CFTC and SEC registered intermediaries. There's also a Payment Stablecoin Act, which imposes requirements for 100% reserve backing. It outright bans algorithmic stablecoins, establishes FDIC conservatorship for insolvent issuers. We also have clarity for Payment Stablecoin Act, which would encompass permitted payment stablecoins. Maybe just to briefly touch upon the banning of the algorithmic stablecoins. Because we've also seen this being introduced by the MiCA regulation. So the question now from the user perspective is that going to have an effect on me as a consumer already holding these assets? Am I going to be forced to liquidate my position or convert the stable coins to fiat-backed stable coins? And if there is a rush to sell, is this going to cause any price instability of the token? Right. So picking up on the MiCA regulation, we've recently seen 2 chapters of MiCA come to effect just last week. However, chapters on enforcement and supervision are coming in force only in December this year. And I think for this moment, it's important to know that there's no consistent market approach as to whether the exchanges are delisting the projects. We have so far seen a few delisting from the EEA-based operations, but not all exchanges are going this way. So as of today, there hasn't really been a significant price impact resulting from such delisting, but I suppose we'll see if this remains in December as well. It is likely that the non-MiCA registered stablecoins will just fade away from the EU, but I think we'll be happy to see this being challenged.
Oh, and for the Hong Kong one, something worth to mention is that it has its own crypto regulatory framework under development. But we shouldn't forget the fact that it's closely linked to a policymaker from mainland China. So that's something that you need to consider as well.
I think we just missed one point that I wanted to pick up on. That no worries, it's fine. That I think we can see kind of 2 trends emerging from the customer protection perspective. So certain regulators incline towards regulating the stablecoins within the payment system regulation, like UK, EU, Singapore, which sort of offers greater protection for the user. Like it offers the stability and reliability of the payment infrastructure. And some regulators are approaching this from the activity-based service provider view on the issuers, which this may prove more flexibility in terms of the project's business models. And I think it's also worth noting that there are certain regulations that we'll probably see being enacted, which may further impact the price of stablecoins volatility on the market, such as staking. I think there's a question if there are certain jurisdictions in which staking has been outright banned. There's regulation regarding proof of reserves. How is this attested? And just a point on legal treatment of tokenized deposits and whether certain regulators will perhaps see stablecoins considered as such. So just moving to potential regulatory action, there are certain regulatory responses, instruments, if you will, that regulators are attributed with. From the top with the most probable ones, restricting trading activities on centralized crypto platforms. That would be limiting trading pairs, imposing trading caps, banning certain stable coins. This can protect users from fraudulent activities, market manipulation, but may also limit access to certain stable coins, users' ability to buy, sell. And the question, I think, remains, is this going to affect liquidity, market access? Is this going to lead to higher transaction costs? The regulator may also restrict operation, basically just outright ban minting of new stable coins, restrict redemption. Limits could be placed on the redemption of stable coins for fiat currency, and this can potentially affect users' ability to exit their position. The regulator may also impose substantial fines on non-stablecoin issuers, and I think the most recent case we've seen was the Terra Labs case, where SEC has imposed a fine of $4.5 billion US dollars. And I think what's interesting there was that the director of the project was fined $200 million US dollars in personal liability. There's also a possibility of the reserves being seized at custodial institutions. This is somewhat often more extreme option if massive legal violations are detected. I think I can skip to the next one.
So our approach to measure stablecoin regulatory risk to stablecoin users is to establish a semi-analytical approach that can objectively help stablecoin users to better understand regulatory risk. So it's going to be we were going to have a stablecoin level assessment crossover with the regional level assessment. So this is the risk matrix we identify at stablecoin level. First, it's stablecoin type, whether it is custodial or non-custodial. Custodial means reserve with custodian off chain, and then the issuance and redemption process are managed by centralized party. And for non-custodial, it is normally referred as the decentralized stablecoin that people have been talk about. We believe regulatory risk is different for these two different type of stablecoin, but it does not mean that non-custodial stablecoin is exempt from regulatory risk, because as we mentioned, trading activity can also be restricted at different jurisdictions. And then the second one, it is the operation location. Where does the stablecoin project is registered? It is very likely linked to whether the project team is going to be sued or whether there's actions happen going to be enforced on them. And then who is the issuer? Who is responsible for the issuance and redemption, and what authorities have a say to those issues? And then the next one is the reserve custodian location. Where are the reserve assets custodian? And then the next one is if reserve bankruptcy remote. If the company goes bankrupt, if other creditor have a claim on the stablecoin reserve, then we manage to identify two quantitative factors for regulatory risk. One is the percentage of the stablecoin supply at key centralized exchanges. So this is the portion of the stablecoin supply at centralized exchanges. How likely it will proxy, how likely trading activity can be restricted by regulator in key jurisdictions like EU, UK, US, and Singapore. And then the last one will be the portion of the real world assets in reserve by region. So for example, holding of US Treasury will have a connection to the US laws and regulations. At the risk matrix level, for the risk matrix at regional level, the main goal is looking at the vibe of the regulatory landscape of a specific jurisdiction. It is a very objective view. It's very complex to analyze, but so we come up with three different factors. One is who are the key authorities, and then whether the regulatory history is rich in the past, not only on stablecoin, but also on other crypto project and crypto company. And then the third one is whether stablecoin regulatory framework, what is the progress of stablecoin regulatory framework? It might be the indication of whether there's a room, whether it become more restricted for the stablecoin to be operated in the area, but it is quite difficult to say because it's case by cases. Here is a case study we come up with to use the risk metric that we identify. We compare USDC, USDT, and DAI. Then you can see that USDC and USDT are both custodial stablecoin, and DAI being identified as non-custodial. For USDC, the operation location is US. USDT is British Virgin Island, and then for DAI is on chain. issuer is Coinbase and Circle for USDC, highly linked to US. USDC at Bitfinex, and then DAI is MakerDAO. Reserve location, USDC is definitely at US. USDT. Yeah. What's the guy's name? Somebody Cantor Fitzgerald. Yeah, claim they are the custodian of the USDT asset. And then for DAI is a very complex case. It's a part on-chain and part real-world asset. So it needs more in-depth analysis for their real-world asset portfolio. Whether the reserve bankruptcy remote. For USDC, they are not. And USDT, I assume they are not, but it hasn't been mentioned. And then for DAI, it is yes for on-chain asset. And for real-world asset, it's by case. If, for example, if it's been set up as a SPV, it is very likely that it's a bankruptcy remote. But again, it needs more and in-depth analysis on their real-world asset portfolio. Percentage of supply at centralized exchange. USDT has the highest percentage in terms of portion with centralized exchange. This can be an indication that when there's regulatory actions on restricting unregulated stablecoin activity at centralized exchange in certain jurisdiction, the one with the higher portion in the centralized exchange is going to be impacted more. And then for USDC, majority of their real world asset reserve are 100% of them are in US. In USDT, according to their report, mostly are US. And then for DAI, I think I get the data from the Dune dashboard. About 22%, at least 22% are in US. For the regional level risk analysis, with US, it has rich regulatory history. It has regulatory action in the past, not only on centralized exchanges, but directly on crypto projects as well. They have a regulatory framework stablecoin bill proposed. And then for EU and UK, most of the action that happened in the past are around centralized exchanges or centralized crypto platform. The MiCA is in application, and then the framework proposed in the UK are under development. It's a similar case for Singapore. To wrap up, regulatory risk is extremely complex and challenging to be assessed systematically, and it requires ongoing effort for regulator and then the industry to establish and refine standards and guidelines, which also creates uncertainties. The key concerns for stablecoin users are: the first one is the direct impact. Stablecoin value get held or get lost. Or the indirect impact. Stablecoin activity are restricted. So we believe that it is the stablecoin and crypto industry should be actively participate in the discussion of the developing of stablecoin regulatory framework. So thank you very much for coming. To follow us for more updates on the stablecoin for other risk categories, please follow the Swap update at Tammy on X, and then you can follow Ola on LinkedIn and Twitter. We have a previous presentation on the other risk category and can be found there. And then I'll share the slides on Twitter as well. The working paper for stablecoin risk assessment framework is the draft is done and it's under review, and then it will be live soon. Thank you.